All right, well, that's a good question because what it does is it strikes right at the core of the structure of the fair tax versus the income tax. The personal income tax, the corporate income tax, which are the two taxes that raise about 65% of all government revenue, have as its base income. So in order to apply with the income tax return filing requirements, you have to report your income. I mean, this seems simple, right? And so part of the problem with the income tax is it requires self-reporting, and it requires people to report all of their income from whatever source. Legal and illegal sources alike have to be reported on the tax return. The fair tax changes the base. The base becomes consumption, not income. And so the fair tax then does not require the filing of tax returns, the reporting of income, the claiming of deductions, any of those kinds of things. The fair tax then assesses the tax at the point of purchase on all consumption goods and services at their final point of purchase. So the retailer collects the tax and is responsible to pay that tax over to the taxing agency. So the taxpayer then is the individual consumer. They don't have to keep records. They don't have to file returns. They don't have to make any kind of reports with the IRS or the state taxing agencies. They just pay their tax at the time of the purchase. So it is a fundamentally different structure. Income is the base on the one hand, consumption is the base on the other hand.
So I guess the question would really more along the lines be, what is the income tax doing that the fair tax wouldn't be doing? And that the answer is so much compliance, so much of the burden of compliance.
Oh yeah, no question about it.